A very good evening to all of you. Welcome to today's practical session number 18 for the year 2024 for demand supply trading. Myself, Surjit Kakkar, and today is Sunday, 12th of May 2024. Now, before we move ahead, let's get done with the basic formalities. So, make sure you people go through the disclosure, which talks about the representation risk disclosure, risk involved in the market, and also about the copyrights. So, today's session is the practical application of demand supply methodology. So, in case you don't know demand supply methodology and you wish to learn it, or let's say you've already gone through my course, but that's just the theoretical part of it. Now you want to understand how to practically apply the methodology and plan trades. That is what we do in these sessions. And yes, those of you who don't know the methodology and if you're interested in learning it, our demand supply methodology course is now available as an 100% free course. The links are available in the description. And during the session, if I talk about some videos or if I talk about some documents, you will be able to find the links in the description. You can use those links to access those documents, to download those documents, or maybe to access those videos. All right, now before we get started with today's example, we do have one uh, trade which was getting carried forward for us from the previous session. So let's start with the review of it, and after that, we'll look into the example for today. So this one was session number 16 for the year 2024, and we did the analysis on the 28th of April. It was a type 1 trade for us, and on the 3rd of May, this is 3rd of May, when the prices came back into the zone. So we already reviewed it when the prices came back. So now what happened? Eventually with the trade setup. So when we talked about this, we said, on this one, our target would be the supply, which was showing us a reward to risk ratio that was a little over 4:1. Now, the very next day, what happened? Prices, they started moving up from this area, already gave us a move which was a little over 2:1. Here you can see that's my 1:1, 2:1. So about 2.5 is what we got as our move the very next day. And as a rule-based trader, what we do is when the prices, they go in our favor, 1:1. So that's the risk we are taking. So when we go exactly the same distance in our favor, which is 1:1, what we do is we revise our stop loss from where the stop loss was placed to our break-even point. So this is where we would have revised our target, revised our stop loss to break even. Now, depending upon your preference, some people might want to include your commissions and have your trailing stop loss a little higher, so that in case it goes back, you don't even have to pay the commissions from your pocket. Some people might be comfortable with paying the commissions from their pocket, and they might want to have the stop loss exactly at the price where they entered the trade. So that's your call how you want to go about it. But yes, this is where you got the opportunity to make it as a break-even trade. And then the next day, you can see we got a move which was approximately 3:1, but we did not come back and hit the break-even point. The target was still really far away, about 4.5. And then what happened eventually? Again, prices came into the zone. So if you made it as a break-even trade, you would have been out of the trade as a break-even trade. But definitely gave us a move which was approximately 3:1. Now again, depending upon your personal preferences, your rules, some people, what they do is, example, once it reaches 2:1, if you want to book 50% of your profits, you can do that, or maybe 25% of your profits, you can do that. So again, different people will approach the markets in different ways and can have different rules. But going with the rule book that I've shared with you, we'll mark it as a break-even trade. Definitely, we got a move which was about 3:1, but it fell, shy of our target and started moving back. Though, we have still not hit the stop loss. We are still inside of the zone. So again, what can happen is prices can move down. The zone can, in fact, the zone is already violated, but the stop loss, what we use is always just a little below the zone, which has not yet been triggered. Or prices can again start moving up, and eventually it can hit your target. But now we are out of the trade and we are done with this one. All right, so that takes care of the trade which was getting carried forward for us. And now that we are done with the review, give me a second. Let me bring up the symbol that we'll be analyzing today, and then we'll start with our analysis for today. All right, perfect. So again, you should be able to see my screen and the charts now. So that's the one we'll be analyzing today. So let's get started. So whenever we talk about trading, we always say trading has to be a very mechanical and rule-based process. And why it should be mechanical and rule-based, I have explained this in a video. The title of that video is How to Start Trading. The link is available in the description. It helps you understand why it is important for us to be rule-based and what is the process which we should be starting with. so that eventually we can be a trader who is more rule oriented versus uh, emotions oriented. So our a trade plan is basically a collection of two documents. The first one is called as the trade plan steps. You can also call it as the walkthrough or the flow chart, which guides us what we need to do step by step as a demand and supply trader. And all these steps, they have their own elaborate rules, which are available in the rule book. Now, this rule book that I've shared with you is a conservative approach with time, with experience, if you want to make some modifications to it, because every trader is not the same. Some people are very conservative, some people are aggressive, so you can make those modifications based on your experience, based on your needs. Again, some people might want to do intraday trading, some people might want to do investing. So that is where your needs can be different, your personality style can be different, and that is where you can make these modifications eventually as you start having more and more experience with the methodology. All right, so our step number one, whenever we start planning our trade, is to define our trade purpose. Now, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, so any kind of exit, right? So, exit does not mean always the profit exit. It can be exit in profit, it can be an exit in loss, it can also be break even, right? So, your exit and the entry, so the duration from the entry to the exit defines your trade purpose or your trade duration. And what I've done is I have divided these trades into four different purposes, and we call them as the hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important, by definition, I said daily income is a trade which can last for a day or few days. But when you're trading markets that are not 24-hour markets, like if you take the example of the NSE market, I'm pretty sure all of you would have experienced whenever the market opens, some stocks they gap up and some stocks they gap down. Now, because of this gap up, gap down, what can happen is if you get a gap in your favor, you might get profit, which is bigger than what you were anticipating on that trade. But similarly, if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we keep a position overnight, it has that inherited overnight gap risk, which cannot be avoided. And that is why my recommendation to all of you is that initially, when you're learning a new methodology, you're still lacking that experience. It's better to follow risk management by doing hourlies and dailies as strictly intraday trades. Do not keep them as overnight trades. Now, for weekly monthlies, we are not anticipating to get the exit the same day. So here we have no choice, but we will have to keep these positions as overnight positions. But that does not mean for weekly monthlies you cannot have gaps against you. It can still happen, but the probability reduces because we are leaning against some bigger time frames. So again, initially hourly dailies are strictly intraday, weekly monthly is overnight. With time, with experience, if you want to include daily incomes into overnight trades, that can definitely be done. So my step one is I need to define my trade purpose, and let's assume I opted I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if you go to page number 28 in the rule book, we start with the topic that is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames that we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis, intermediate is used for trend analysis. On the lower time frame, we identify our areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes like fine tuning the zone, different kind of entries like your type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Now this table is for the NSE market because this is only open for about 6 hours and 15 minutes for a very short duration during the day. But if you're trading markets which are open for longer durations, then you can refer to this table. This can be used for commodities, for forex, for cryptos, right? So, whichever markets are open for longer durations, so this is what you can refer to. But since we are looking at NSE, we'll be referring to this table. And as I opted, I want to plan monthly income trades. So from this table, I got to know my time frames will be monthly, weekly, daily 60. Monthly will be the higher time frame, which is used for curve analysis. Weekly will be the intermediate, used for trend analysis. Lower time frame will be daily. That is where we get our ACTS from. ACTS stands for stop loss, entry target, and size. And in case you need to reduce the refining time frame, then your refining time frame will be the 60 minutes chart. It can be used for multiple purposes like fine tuning the zone, type 2, type 3 entries, or in case you need to apply some additional rules. And that is also where this time frame can help you. So as soon as I'm done with my step number one, now I have the clarity to what time frames I'll be using and what is going to be the purpose of each and every time frame. So my challenge number one is taken care. Now comes challenge number two, and that challenge number two is, if I talk about the NSE exchange, we have approximately 2000 plus companies listed. So humanly not possible that every day I sit and analyze 2000 companies. So what I need to do now is I need to have a process in place which can help me get a smaller list out of these 2000 companies, because if I have a smaller list, I can do my analysis almost every other day, but going through 2000 symbols, it's not an easy task. And the way we do this is by using certain computer programs which are called as scanners or screeners. Now, very, very important, no matter what scanner or screener you're using, you can never blindly buy or sell the symbols which it is shortlisting for you, right? So you will always have to use a scanner or a screener to get you a smaller list which needs to be analyzed manually, right? So it cannot be something like, scanner is throwing some results for you and you start blindly buying those symbols or blindly selling those symbols. That is something which can never be done. So again, job of the scanner is not to tell you what you need to buy or sell. Job of the scanner is to give you a smaller list so that you can analyze and check which one is matching with your trade plan. The one that matches with your trade plan can be your opportunity. The one that doesn't match with your trade plan, you will simply skip it. So few examples of these scanner screeners. Example one, if you go to my website, you will see under the free tab, we have some scanners designed for you, and those are based on some moving averages which can help you in shortlisting symbols. Second example, on my YouTube channel, if you search for scanner, you'll be able to find few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. Again, you'll be able to find one video, right, which will help you in understanding what is top-down analysis and how you can even use that for shortlisting symbols. So these are few examples, but let's practically see, look at a few of them before we move ahead. So like I said, once you go to our website, under the free tab, you have the option stock screener. Because I want to plan MIT trades, I can click on the long scan and the short scan. So here you can see the long scan is shortlisting around 10 symbols for me, and the short scan is shortlisting one. So it still says running. So if something like this happens, just refresh it and it will generate the results. You can see this one is shortlisting one. So now you can see out of 2000 plus symbols, I got a list of 11 symbols, and now I can analyze these 11. Out of these 11, if anything matches with my trade plan, it can be my trading opportunity. If nothing matches with my trade plan, I don't have anything available. Now, many times what can happen is the list that you get might be a very small list, like you can see today, only 11 symbols, or maybe it is not generating any results because nothing is matching with these conditions. Or even otherwise, if you want that my list should be a little bigger list so that I can go through more number of symbols to identify my opportunities, then what you can do is you can see that in this scanner, I have given 5 different conditions. Disable the third one and run the scan again. And I'll do exactly the same thing here. Disable the third one, run the scan again. And now you can see that initially it was only shortlisting 10, but now it is giving me 124. And for the short scan, it was shortlisting 1. Now it is giving me 8. So we have 124 plus 8, which is 132 symbols to look into. So it's not that you have a list of 600 or 700 symbols to look into. It's a very small list, about 132, which I'll say can be easily analyzed in about an hour. But if you still feel it's a very big list and you further want to filter it out, you can use different filters. Example can be that instead of cash, I can say I only want from the symbols that gets traded in futures. I can run the scan again. I can do exactly the same thing here. Futures, I'll run the scan again. And now you can see we have a list of 35 plus 4, which is 39 symbols to look into. So similarly, you can have different filters. In fact, if you go to the screener section, you can see you have over 150,000 scanners available on this website, some based on fundamental analysis, stop loss, candlestick patterns. If I further go down, you can see you have your range breakouts, bullish scan, bearish scan, then you have your intraday bearish, intraday bullish, crossovers. So you have a number of scanner screeners available to you. So out of this, whatever you feel is the right fit for you, you can use it to get a smaller list. Like I already said, these scanner screeners never tell you what you need to buy or sell. So it doesn't matter which one you're using. At the end of the day, it's just helping you get a smaller list, right? So it's your call how you want to get that list. So now you saw that we used a scanner and we got about 132 symbols to look into. Now, once you start analyzing these few challenges, which you will realize, challenge number one, a majority of the symbols in this list might not have a quality demand zone or a supply zone on the lower time frame. And the reason for that is because none of these scanners are based on demand supply zones. They are based on either conventional technical analysis or fundamental analysis. So that is why just because something is getting shortlisted does not guarantee that you'll have a zone available to you on the lower time frame. And second, few of them which might have some quality areas, those areas might be really far away from the current market price, due to which you'll have a longer waiting period before the prices are back to your zone. And during your waiting period, whatever price action happens, develops, it might disqualify the trade setup for you by the time prices are back to your zone. So these are some of the challenges we face when we are using scanners that are conventional technical analysis or fundamental analysis based. And to overcome these challenges, I've also created two custom built tools. One is called as the alert service, the other one is the screener. Again, these are not call giving or tip giving services. They are scanner screeners. The only difference is that they are purely based on demand supply zones. So if you look into the example of alerts, so we do have demo channel available for alerts. We have the demo channel for uh, NSE, for MCX, and also for few forex symbols. And what happens on this demo channel is, as per the Indian Standard Time, you can see for NSE 11:15 we start giving you alerts for about half an hour. So from 11:15 to 11:45 a.m. Indian Standard Time, you get the alerts for NSE. And here you can see what it is doing is, as and when these zones are getting formed, it immediately notifies you. So you can see at 11:15 we had a formation of a rally-based rally on Torrent Pharma on the 15 minutes time frame. That's the proximal value, that's the distal value. Here you can see on Siemens we have a drop-based rally on the 5 minutes chart at 11:15. Similarly, if I go further down at 11:20, we have on Dixon, it's a rally-based drop. On the 5 minutes chart, proximal value, distal value. Then you have Glenmark on the 5 minutes chart, on the 5 minutes chart, on the 5 minutes chart. These are the uh, daily alerts. These are also the daily alerts. These are also the daily alerts. So you can see, as and when these zones are getting formed, it immediately notifies you on which symbol, on which time frame these zones are getting formed. And again, I'll add, these are not call giving or tip giving services. It is a scanner which is helping you shortlist symbols as and when these zones are getting formed. So that's your alerts. Similarly, we have another tool which is called as the screener. So just to show you an example of screener, you can see here I have applied the screener on the chart, and in this screener I have given around 40 symbols. So after giving the 40 symbols, I have given my proximity setting at as 1%. So what I'm telling the screener is, okay, I've given you these 40 symbols. Now out of these 40 symbols, tell me in which symbols I am within 1% proximity to a demand area or a supply area. And can you see it shortlisted for me? So now I don't have to go through so many symbols. Let's say if I'm only planning long trades, I just have to look at one. If I'm planning both long and short, then I have 1, 2, 3, 4, 5, 6 symbols to look into on the short side. So and similarly, you can apply the screener on multiple charts, and you can have a very big list where it is just shortlisting for you and telling you, okay, these are the symbols which are closer to the demand areas or to the supply areas, and based on your proximity settings, they will get shortlisted for you. So here you can see, just as an example, it is telling me that on Nestle, we are close proximity to the demand zone. So if I bring up Nestle, okay, we already have the chart of Nestle here. So you can see we have the demand zone, and my current candle low will be within 1% to the proximal line. So if I just show you here, can you see we are in about 0.92%, and that is what the screener does for us. It helps us shortlist based on whatever proximity settings you're giving. So again, the difference between the two is alerts will help you identify symbols where the zones are getting formed on the current day, right? Live during the market, as and when the zones are getting formed. That is what the alerts help you with. And screener will help you based on the proximity setting, irrespective whether the zone is formed today or a day ago or a week ago or a month ago or a year ago. As soon as we are within that proximity range, it will get shortlisted for you. And again, I'll add, these are not call giving, tip giving services. These are scanners purely based on demand supply zones. And again, your step two is to get a smaller list. I just showed you a number of options that are available to you. Definitely, if it is, if your process is more in sync with demand supply zones, higher is the probability you'll be able to find some opportunities. But if you're using some conventional techniques, definitely you might have to go through a bigger list to identify some opportunities. But at the end of the day, it's your call how you want to get that smaller list. The process can be as simple as, I don't want to use these any scanner screeners. I want a smaller list. I will only be analyzing my Nifty 50 stocks, or maybe I have my own favorite list of stocks which I want to analyze every day. So choice is yours how you want to get that small list, but you will have to use some of the other process so that you have a smaller list available to you. Otherwise, analyzing 2000 stocks every day is not an easy task. So wherever your process is, apply that process, get your smaller list. Now, once you have that list, what we'll do is we'll have to analyze all these symbols one by one. Whatever matches with your trade plan is your opportunity. Whatever doesn't match with your trade plan, you simply skip it. Now, let's assume the very first symbol in this list was ABC. So what am I supposed to do now? I need to go to the lower time frame on ABC. And now the question is, what is my lower time frame? The answer we got from our step number one. When I opted, I want to plan monthly income trades. My time frames were monthly, weekly, daily, and 60, right? So daily was the lower time frame. So here daily will be my lower time frame where I need to identify zone. And by zone, we mean any of these four structures. It can be a drop based rally, rally based rally, rally based drop, or a drop based drop. So if I go to this chart, assuming this was the very first symbol. Now, the first thing is, when we talk about a demand supply methodology, always say it's a price action based methodology, price action. Now, the question is, what do we mean by price action? Price action means the action done by the price. And what action can price do? Only two things. It can either move up or move down. It cannot do anything else. When price is moving in a narrow range, we call it as the period of pause, or we can also call it as the basing. Now, when we initially start learning demand supply methodology, our eyes are not trained to identify these structures. So that is the time we lean against a process which is called as boring exciting technique, because you will see majority of the zones can be identified based on boring exciting technique. And the boring exciting candle and the explosive move indicator, I have created both these indicators as an absolutely free indicator. You can use them for free forever. And we have another indicator which is called as the demand and supply zone indicator, which is applied to my chart as of now. And you can see this is more like GPS, that I don't need to identify my zones now. It automatically identifies and plots the zone for me. And we also have the demo available for demand supply zone indicator. So just in case you want to try it out, you can just go to the indicator section and search for demo demand. Search for demand supply zone indicator. DEM. So here you can see in the community scripts, you'll be able to find demo demand supply zone indicator by Surjit Kakkar. You can use this indicator for free. It's the demo version. The limitation of the demo version is that you'll only be able to apply to the daily time frame. You'll not be able to use it on other time frames. But yes, you can at least apply it and try it out and understand how the indicator basically works. So yes, the step 3 was to identify the zone, and now it is much more easier for me because the indicator is doing the heavy lifting for me. It is identifying the zones automatically, plotting the zones for me, which makes my life much more easier and also makes it mechanical. So this is where we have our demand area. So my step number 3 is now complete, which is identify zone. Do we have a zone available? Answer is yes. Now, once you have identified the zone, does not mean you can blindly trade it. The next step is to qualify it, for which we'll have a two-step process. Step 1 will qualify it based on certain conditions. Step 2 will qualify it based on the booster scoring. So the very first condition we check is that can this zone be a case of level on top of level? Now, why do we start with level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from the zone we have already identified to a different zone. And the way we verify this is very simple. So if you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So when your intermediate time frame zone on the lower time frame divides into multiple zones, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So it needs to be a coinciding level. If it is a coinciding level, it might be a case of level on top of level, but if it is not a coinciding level, then it cannot be a case of level on top of level. So let's verify that the zone we have identified, does it coincide with any intermediate time frame zone? And in this case, my intermediate time frame will be weekly. So here you can see on the weekly, we do have this structure, which is a rally based rally. Let's change the color. So the one marked in pink is my intermediate time frame zone. The one marked in green is my lower time frame zone. So is my lower time frame zone inside my intermediate? The answer is yes. Now, when we talk about level on top of level, it is not mandatory that the other zones might be quality areas. So what I can do now is to check whether we have more areas inside of this. I can change my indicator settings to all demand supply zone structures. And now you can see we just have one zone. We don't have multiple zones. So that basically helps us understand it is a case of coinciding level, but not a case of level on top of level. Now, even in the past, you have seen me doing this many, many times that whenever I see a zone which is a coinciding zone, I prefer to have my stop loss from the distal line of the intermediate time frame. And the reason for that is, let's say if I don't make the shift, what if prices they go a little deeper into the intermediate time frame zone, stop me out, and then start going in my favor? So I like to have my stop loss as safely as possible placed. So that is why, because it is a coinciding level, I would prefer to have my stop loss at the distal line of the intermediate time frame, and that is where I've made this modification that let me push my distal line a little lower. So yes, it was not a coincide sorry, it was not a case of level on top of level, but was a coinciding level, due to which I did make a small little modification. Next, this zone is not because of a gap, therefore gap rules will not apply. Definitely a pivot or an authentic zone because it's a drop-based rally structure, and we always assume drop-based rallies and rally-based drops as pivot and authentic zones. So whenever we see a pivot and authentic zones, we need to qualify them, and the way we qualify them, I have already given you the rules in the rule book. If you're an aggressive trader, then what you'll do is you'll check that before applying the boosters, can you see we have still not moved on to the boosters? Make sure the move from the zone was able to violate at least one opposing zone on the intermediate time frame. So since we know that structure of pivots can be a little lesser probability, we want to increase that probability, and the way we are increasing that probability is that the move from the zone, can you see the move which we had, should have violated an opposing zone. So if this is demand, my opposing zone would be a supply. So it should have violated a supply zone, but not of the same time frame of the intermediate time frame. Why? Because if a smaller time frame zone is violating a bigger time frame zone, that definitely tells us that it might have some strength. So let's go to our intermediate time frame, and here you can see if I do a replay. So this is where our zone was formed. And at that point of time, you can see we had our opposing supply, which is right here. And you can see when we started moving up, this supply was definitely violated. So the condition that we want, that the move from the zone should have violated an opposing zone, it definitely is available, which means based on the aggressive rule, this is qualified for us. Now, some traders, like I said, might be conservative, and for conservative people, I have given another rule, which is basically two conditions we look into. So the very first condition is we need to have an impulsive move on the intermediate time frame. So again, if I go back, you can see on the intermediate time frame we have an impulsive move. The move from here was able to create a new high by breaching this high. That is why this is called as an impulsive move. So my condition number one is definitely applicable. Condition number two is that I also need to have an authentic zone on the refining time frame. Authentic zone means a rally based rally or a drop based drop. So if I go to the refining time frame, which in this case would be the hourly chart, and I can also change this to all zones, because on the refining we don't require, in fact I already have refining defined, so I don't need to change the settings. The indicator will do automatically for me. So you can see inside my uh, intermediate time frame zone on the refining time frame, no, so inside my lower time frame zone on the refining time frame, I don't have an authentic zone, which is a rally based rally. Here also we have a drop based rally structure. So if you are a conservative trader who is following the conservative rule, then what is going to happen at this step where you applied the rules of pivot non authenticity? Is the zone qualified for us? The answer will be no, and you can't move ahead. So you're done with the symbol, you'll move on to the other symbol. But if you're a trader who's following the aggressive rule, then after applying the applicable rule, is the zone qualified for us? The answer is yes. And that is why I always keep saying different traders, different personality styles, different rules. You might have different opportunities available to you. So yes, as an aggressive trader, this is definitely qualified for us because it was able to violate at least one opposing zone on the intermediate time frame. So now that I know this is qualified, I can move ahead with the booster scoring. So if we start with the boosters, the very first one is, okay, let's go back to the daily first. And let me also draw our entry, stop loss, and back to the entry. So applying the boosters, the zone is definitely fresh, gets a score of 3. Strength, we have an explosive move, gets a score of 2. Time at the zone, we only have 2 candles, gets a score of 2. Reward to risk ratio, we are definitely taking as an assumption. But even if you see as if now, can you see that is where we have our opposing zone? So we have 1 is to 1, 2 is to 1. We don't have a 3 is to 1, but let's say if you're okay with the 2 is to 1 target, then as if now it's not a challenge. We do have at least 2 is to 1 available to us. But when you're planning overnight trades, ideally we would like to go for a 3 is to 1. So again, I'll add one challenge is your reward to risk ratio, but we'll also talk about it as we move forward. Next, now what is the location? If I go to the monthly time frame, what you can see here is that I do have a demand area. But again, we don't have supply. But the same logic, if the prices have moved down, there can be only one reason, and that one reason has to be supply. It's just that that supply might not be visible on this time frame. But if I go to a different time frame, we might have some supply areas here. So you can see we do have the supply area. So that is something we have talked about in many examples. So what I can do now is I can do my curve analysis by taking it as a reference point and drawing my curve, which will put my location as the best location. So can you see from here till here we can draw, and this is my very low of the curve, this is my low of the curve, middle of the curve, a high of the curve. But we don't have very high of the curve because we don't have a higher time frame supply structure. So yes, we are planning the trade at the best location, and at best location we get a score of 2. Now coming back to, like I said, even if we don't have a 2 is to 1, I mean a 3 is to 1, it is still okay. Why it is still okay? Because if I go to the rule book, you will see that in the rule book, I have given you a rule for the target. And the rule says that for target, you can use the opposing fresh zone on the lower time frame, and that is what we were looking at, which was showing us a little over 2 is to 1, but not a 3 is to 1. But when you're planning your trades at the best location, you can even use the intermediate time frame. So that is the reason, even though my lower time frame is not showing me a 3 is to 1, I can check it on my intermediate. And on the intermediate, if you're looking for your fresh area, you can see it's really far away. This one is already tested. So in the intermediate time frame, you definitely have more than 3 is to 1 available to you. So that is why, even though the lower time frame was not giving me the kind of target I'm looking for, we can use the intermediate time frame because we are planning the trade at the best location. And this is why I always keep saying that do ensure that you're attending these sessions regularly, because from every other session you will have something to learn, or maybe some rules that are already available in the rule book. Will be able to see examples how those rules they get applied. So yes, after no, we have still not applied all the boosters. We were still at the location. Now when you're planning your trades at the best location, trend becomes irrelevant. So it doesn't matter whether it is up, down, or sideways, it is going to be a score of 1. Move from the zone has already happened. It is not a case of level on top of level, but definitely it was coinciding. Now whether it works like a trap or it doesn't work like a trap becomes irrelevant, and the reason for that is because even if it is 0, it's still a type 1 trade for us. Even if it is 1, it's still a type 1 trade for us. And if I take a horizontal line here and start pushing it up, you can see almost this area has been working like support, has worked like resistance, again working like support, and now we are just coming below it. So yes, we do have that possibility that this might work like an area of trap, for which we will give it a score of 1. So let me give it a score of 1 for it. So if you look at the overall scoring, we have a high quality 10 out of 10 and high probability 7 out of 8 setup for us. And the high quality, high probability trade setup can be done as a type 1 trade. So after applying the boosters, we got to know that this can be done as a type 1 trade. But again, I'll add, only if you're an aggressive trader, this is a valid trade setup for you. If you were following the conservative rule, this was not a valid trade setup for us. Now, no matter how high the quality or the probability, any trade can be a stopped out trade. So that is why we need to be ready for the worst case scenario, for which we'll do our proper position size calculation. Whenever the prices are back, we'll re-verify, does it still qualify based on our trade plan. If the answer is yes, we place our order based on the entry type. In this case, it is a type 1 entry. And once your trade has been executed, the last step is your trade management, where step 1 is to 1, we make it break even. And after that, if we get the opportunity to trail onto it, we start using our trailing stop loss. So this is how we plan trades, very mechanically, very rule based, and that takes care of today's example for how to plan trades using demand supply methodology. Now let me look into the chat box and touch upon the queries which you people have. But before I do that, I would definitely like to add that do ensure you people subscribe to my channel, because generally this session I do at 10 p.m. Indian Standard Time, but today I had to start early because I was not available in the evening. And if you are subscribed to my channel, you will definitely get notified when I am planning these sessions, so that if you're available, you can join in live. And in case you're not available, you can at least watch the recordings later. You'll get to know that the session definitely happened. And yes, I'll also add, if you are liking these sessions, do hit the like button. And if you have any friends, family members, or if you're into some trading groups, do share the link to my course, because a lot of people are struggling with trading. You never know, this might help them. And you can also share the links to these sessions as well. So let's see what do we have in the chat box. All right. So the first one is Ottawa Investor. Thank you for your time and lessons. You're welcome. And I hope this is helping you being a better trader. That is what my objective is at the end of the day. What's the logic behind explosive candle? You are using ATR to define candle in explosive or not? See, again, let's not get into how we are doing it technically when it comes to programming. But what we basically mean by explosive candle is any candle which is much bigger than the average candle size, right? That is what we mean by explosive. Now, how you can identify that programmatically, there are a number of ways to do it. We'll not be getting into those logics. Okay. Just want your way of identification, high lows, higher highs manually. It's very subjective, but I'm sure you will have a better mechanical method for it. So what you're saying is identification of the trend, right? So should I be using high lows, higher highs, lower lows, or should I be using maybe the demand supply zone indicator, which automatically identifies the zone violations for me, and based on zone violations, it tells me should I be taking the trend as an uptrend or a sideways or a downtrend, or maybe I want to use some other indicator. See, when it comes to demand supply trends, they do not have a lot of weightage. Now, in this example, like I said, we are planning the trade at the best location. So at best location, what can happen is, even if I'm on a downtrend, that downtrend can get converted into an uptrend. So here, location has no meaning for me, and that is the reason, irrespective of the trend, we can give it a score of 1 in the boosters. So again, at the end of the day, whatever is easier for you, use that process to do your trend analysis, be that uh, price action, be that any indicators, be that zone violations. It's your call, whatever is the easiest way for you to understand or identify the trend. Do increase, decrease in volume in our demand supplies. Okay, so what you're saying is the increase and decrease in the transaction volume. I was thinking, maybe some problem with the audio volume here. So let me read your question now. So our demand supply zones that your trade is going to work, big boys making the move. See, the fact is there is no way to do that. And the fact is you might assume that at the best demand areas or supply areas, you might be able to see a lot of volumes. But the fact is, eventually you will realize that some of the best demand supply zones area, they don't have huge volumes. They will have average volumes or maybe less than average volumes. Now, what is the reason for that? The reason for that is, yes, somebody wants to buy, let's say if it is a demand zone, somebody wants to buy huge number of shares, but do we have enough sellers to provide those many number of shares? The answer is no, right? So what is going to happen? The sellers will get absorbed and the prices will move away from that, and that is why we assume that we'll still have some pending orders there. And if they are already huge volumes, then in a way, if you think about it, maybe they have already got their fills. So why would we even want to place our trades at those locations? So as you start moving ahead, you will see volumes, they will not help you a lot, because again, it is the other way around. If you already see huge volumes, then probably those areas have already been depleted. The volumes there, whoever wanted to buy or sell, has already been absorbed. So that's not going to help us. And personally, I don't even use volumes on the chart, because like I said, volumes, they don't give us any edge. The only reason we should be looking for volumes is just to ensure before planning the trade, the symbol is liquid enough for me to participate, so that I don't get hurt by the spread, right? It is easier for me to enter, it is easier for me to exit. Other than that, volumes will have no meaning for us. All right, so Leggin candle almost looks like a base candle in comparison to the other candles. How do you qualify? See, again, what you're talking about here is, now if I do something like this, so now what the indicator is basically doing is, it is trying to understand what is the size of the candle related to some of the candles in the past, right? and based on that it understands whether it should be taking it as a leg-in or it should be taking it as a basing candle. So this is where it understands that I should be taking it as a leg-in candle because the size is probably a little bigger than what the basing candles would be on this chart, and that is why these two are taken as basing and this is taken as a leg-in. And yes, uh, this is why I say, if you are using a mechanical process, it definitely makes things easier for us. And another example you can also see here is that both these candles in the basing are not boring candles, right? They are exciting candles, and that is what I also talk about. That initially we do start with boring, exciting, but eventually we'll have to move on to price action, and that is what the price action is depicting to us. That we moved up, we paused for a while, we started moving up, which is basically a rally-based rally structure. So yes, it is more based on price action, and in fact, when we were scrolling through different time frames, that is also you could see it much more clearly that we do have a area of demand here. You can see we have this. In fact, I can call it as a drop and a base and a rally structure. So can you see on this time frame, it looks much more neater to us, and this is the beauty of the indicator that even if at times your eyes might not be able to comprehend it, the indicator might do it because it has been designed with a lot of things taken into consideration. But yes, it's definitely a rally-based rally structure. Even if I say, if you look at visually, yes, you might not call, if you're looking at visually, you might not call it as a rally-based rally, but at least you might still be able to call this area as a rally-based rally structure. And then the same area becomes your weekly zone. So yes, the indicator will identify based on some mathematical calculations, and if those calculations are holding true, to call it as a structure of demand, they will be marked for us. And yes, that's how it is. But again, not to worry. As you start having more and more experience, your eyes might also start might start eh, pinpointing these areas and understanding what to be taken as a leg in, what to be taken as a basing, and what to be taken as a leg out. All right, so that takes care of our today's session. I will be catching up with you people now the next weekend. And till then, trade safe. Enjoy your Sunday. Take care. Bye bye.